Welcome to another Market Matters weekly video update. I'm Nicholas Forsyth, Director at Market Matters, and I'm joined again by James Gerrish. How are you today?
I'm well, Nick. How are you?
Yeah, not too bad. Thanks for asking. Just want to kick things off. Reporting season, we're about to start. People call it confession season, what we're going through at the moment. Now, is there anything in particular you're watching at the moment, or for investors watching, what should they be, I guess, anticipating, and how are you playing it and structuring the portfolio accordingly? I know it's a broad question.
Yeah, well, I've been watching a few blow-ups in the last little while. A lot of stocks in this confession season, so it's the period before earnings season. So if a company's got anything material to come out with, they do so before they actually report. So there's been some pretty big blow-ups in the last month or so. It's been good to be avoiding those, Nick, to be honest with you. So in terms of reporting, we're going into what the market's expecting at this juncture. We're expecting strong earnings growth in this reporting season. So we've had 2 years of earnings growth declines. So we're going in expecting 18% earnings growth, and that's obviously positive.
Well, anything less than 18% earnings growth, would that be a catalyst for a correction, or do you think, with all the forecasts, they're reasonably accurate and we should expect at least the market to hold this level?
Yeah, I mean, consensus is pretty well adhered to, but 18%, if you break it up, if you strip resources out, and that's where the bulk of the earnings growth is coming from, if you strip resources out, the rest of the market is going to grow earnings by 5%, which is about the same thing as they did last year. So the rest of the market hasn't really changed. We've just had a big uptick in resource earnings, and that's driving the EPS re-rate of the market. So that's conditional upon commodity prices remaining high. There's probably some room for commodity prices to drop and maintain that earnings, but the real risk is around those commodity producers and what they do over the next 6 months.
And we talked about in the morning report this morning, the mining space, we want to buy these stocks at lower levels. If you're long the stocks, would you be taking profits or, just running tight stops?
Personally be taking profits here leading in the reporting season. There's a lot of positive news baked into the cake. That said, we're anticipating higher inflation, etc. globally. That's going to be supportive of resource earnings. And if you think about spot commodity prices and what analysts have got in their models now, analysts are still not putting in spot prices. They're putting in lower forecasted prices. So if commodities either stay where they are or they go higher, then there's probably room for re-rating higher or upgrading earnings expectations even further than where they are now. So the risk is that commodity prices pull back sharply. If that doesn't happen, resources will stay very well supported over the next 6 months, I'd say.
Okay, I just want to delve deeper into the high PE side of the market. Saw Aconex the other day off 45% in the day, and it's gone down further since. Now, just from a strategy standpoint, for the investors at home that get the service and sometimes question, is there method to this madness? What is the way to play that space, or how do you play it? At this point in time, and I guess moving forward into a market that's starting to top out in that space?
It's hard to say, a high PE stock should be avoided or expensive stock should be avoided, because, it really comes down to the understanding of the E in the equation. So, what are earnings, what has been the historical trend in earnings, how predictable are those earnings going forward, and what are the external factors that could come out, and hit those earnings. So, in terms of Aconex, for instance, Aconex came out and had a pretty big earnings downgrade. They're a smaller company. It's $1 billion market cap company, or was. So it's not that small, but they haven't had. They've got a really good product, but it's monetising that product that's the important part. They came out and cited Brexit and Trump. If you can't come up with a better excuse, go out there and cite those two things. I'm sure a lot of people are using that excuse for things.
Oldest excuse in the book now.
Well, it seems to be, but that shows the risk in a company like that, a new company monetising a fairly new IT platform, etc. You then look at other high PE stocks, CSL, Healthscope, that are in our portfolio, Ramsay, that's not in our portfolio, but it is a high PE stock. They've got a really strong track record of earnings. They've got a high degree of transparency and predictability of their earnings going forward. So you can, and they've been growing their earnings strongly. So you pay up a higher multiple for that. So when you look at a multiple, you have to look at it in context. The context is how quickly those earnings are growing and how predictable they are and stable they are going forward. So that's what we look at.
Fantastic. Fantastic. And lastly, I just want to, I guess, put you on the spot a little bit here with the Australian index and the American index. The Dow broke through 20,000 recently, which was, I guess, a big overhead resistance level. But recently it's been a bit choppy. It's broken down below, above, and along with the S&P. Our market's at about that 5-6 level after being as high as 5-8. We have called for 6,000 sometime in the near term. What are we expecting short term? Further downside before more upside, or has our view changed? And for the US as well.
Yeah, no, our view hasn't changed. So, the market's pulled back down to 5,600. That 5,600 level offers some pretty good support for our market. So, we opened high today and closed near its lows. So there's not a huge amount of underlying buying here. And where we go will be dictated by reporting season. But, our view is the market will probably, local market will probably tick between 5,600 and 5,800 for the next month or so. The US market, broke above 20,000 on the Dow. It's come back to sort of 19,600. 19,850 I think it is at the moment, down to 19,400 is our prediction. So another bit of downside in the market, a 4% decline in total, and then we'll go up and make new highs. So this recent softness and weakness in the market is something we're going to be buying rather than selling into this weakness, waiting for an eventual peak in the market, and then we'll turn more negative.
And we've still got a bit of cash left, which is fantastic. So
high 20s, so yeah.
Yeah, fantastic. So thanks everyone for viewing. As always, any questions, feel free to reply to any of the reports, and James will answer them in the Monday report. Conversely, you can always give us a call on the 1300 number. That is 1300 301 868. Thank you.